Good afternoon, everyone. Thanks for joining this session. We started the Sustainability Conclave on 14 July, and the idea was on how do we discuss different aspects of sustainability and how do we take decarbonization, materials and circularity to actual actions. As we are coming towards the end of the conclave, we are now talking about the most critical part, financing, that really will make sure that action happens. We've been constantly hearing that financing is the gap. We need more money to flow into the sector. We need more different kinds of innovative financing solutions for the these innovations to scale. So now here we are talking more about what does it really take to finance a globally competitive, sustainable and inclusive supply chain for textiles. To take this discussion forward, I would like to call upon our esteemed panelists for the day. First up, we have Komal Sahu, Chief of Sustainable Finance at AVPN, where she works on mobilizing capital for sustainable development across Asia. Komal, maybe please have you on the stage, please. Then we have Mr. Girish Aiwali, Chief Executive Officer of the Impact Investors Council, India's leading industry body for impact investors. Girish, sir. Next, we have Mr. Akash Shah, partner at Peak Sustainability Ventures, where he leads investments in climate and sustainability-focused businesses. Akash. And finally, the moderator for the session, Mr. Abhinav Bhatia, partner, blended finance and innovation at Satwa Consulting, with over 18 years of experience in development finance and impact investing. Okay, over to you, Abhinav, now to take this forward.
Good afternoon, everyone. I was just looking at my watch to say whether to say good afternoon or good morning. But welcome, everyone. I hope you've had exciting 2 days and the discussions have been engaging enough. We'll try and make this panel engaging for you guys so that you can walk away with some learnings, and we'll be happy to learn from you at the end of the session as well through your questions and answer session. The panel focuses on around the circular economy and textile recycling theme, but how do you finance those themes? How do you finance a globally competitive, inclusive supply chain? And esteemed panelists over here have experience working across geographies, investing in such supply chains, and making sure different forms of capital can work together. And that's what this panel will be focusing on. We have Girish from IISc. Girish focuses on getting industry panels together, getting different forms of capital together, and IISc works towards making sure that different forms of capital can work towards development themes. We have Komal from AVPN. Komal works across geographies to make sure that you're getting different forms of capital to work together. And we have Akash, who's an equity investor at Peak Sustainability Ventures. I'll start with you from Girish. Girish, if you can share a brief overview on the sustainability finance landscape, given that you work with various types of capital together, and how is it structured specifically in India currently, and what are some of the best practices that you've seen?
Okay, thank you so much for that, Abhinav, very kind of you. Just a bit about Impact Investors Council. We are an industry body, very similar to what CII, FICCI, IVC and ASSOCHAM are, but we are focused on impact investing. Last year, we took a deep study on the just transition in material circularity in India's fashion landscape. And our understanding has therefore come from that study. Now, to answer your question, Abhinav, there are 4 pillars of financing on the sustainability thing. And these are on the impact investing side. Second is your developmental finance institutions. Third are your philanthropic institutions. And fourth are your the normal debt market, which is your venture debt and your banks. On the impact investing side, we have, from our study, and I can share some examples. So, for example, Akash is here from Peak Sustainability. They have invested in Indra Water, which focuses on industrial wastewater recycling and treatment. Similarly, there is a fund, Omnivore, which is more famous for its investment on the agri side and on the climate side. Now they have also invested in an alternative material startup called STCH. And then there is also investments that are happening on the collection, sorting, and that infrastructure. On the DFI side, India is not seeing perhaps the kind of action or initiative that it should have been seeing. Bangladesh is perhaps ahead of India on that front. But on the philanthropic side, we have examples like H&M Foundation, we have Lodis, and we have IKEA Foundation, which have done exceptionally well in terms of providing the initial catalytical capital to make projects investable from both the equity side as well as the debt side. And then on the debt side, you have the normal banks, and then you have venture capital funds, which go by their own parameters of assessing a balance sheet and then making investments on that strength. Then again, on the impact side as well, there are some impact debt funds as well, so which have come forward for that kind of financing. So we have examples from Avishkar, for example, that has done some work in this space. So overall, I would say that the industry is still needs a fair degree of formalization. One. Second, financing structures have started, but since the industry is in nascent stage, those financing structures are also still evolving and will perhaps need to get evolved further. And obviously, all the components will have to work in harmonious blend with each other, which is your equity, your debt, the philanthropic part, and then of course the developmental financial institutions playing their own role. Thanks.
Got it. Thanks, Girish. Thanks for overlaying the market beautifully for us. Komal, if I come to you, Girish works more with investors, and my question to him was more about India. But my question to you is more about global value supply chains that you've been working across. What do you think are the perceived risks or challenges associated with financing, both from a supplier and a receiver perspective? And can you give us some examples where you've seen this work beautifully?
Thank you so much for inviting me, Abhinav. We are, again, background regarding AVPN. I look after sustainable finance at AVPN. We're a network of investors, global investors, but particularly focused on moving capital towards impact for Asia. Again, very much like IISc, we have some DFIs that are part of our membership network. We have impact funds, we have corporates, we have family foundations, and so on. So again, given our mission, we focus on how we can address some of the impact goals for the region. What we've seen is obviously livelihoods has become a very big conversation globally. And the fact of the matter is that this sector employs over 45 million people within India, and more so when we look at Southeast Asia and PRC and so on. So many countries, many geographies have taken a very strong lens towards sustainability. For example, we were discussing earlier about China. There's a big drive towards making sure sustainability, whether it comes to water, whether it comes to solarization of the sector, whether it comes to looking at circularity. Many of these issues have been addressed with government intervention. So, we've seen, again, there are, in many cases, in Southeast Asia, there are initiatives that have been taken up at government levels to address sustainability issues. A regulatory kind of lens being used as well, demand with respect to sustainability from corporates, and that pushes pressure down, as you know, towards the supply chains as well. In this case, in India, for example, 90% of the supply chain is with the MSMEs. So therefore, there's a push towards ensuring that sustainability can be addressed at that level, and that's very hard because these are fragmented, they're smaller in nature. The risk perception that exists around these small entities that are unable to go out to the market and borrow, and they're primarily looking at debt as opposed to equity. They're not willing to dilute because it's family and entrepreneur ownership. So again, that risk perception needs to change. So there has to be a great business proposition to say that invest in these businesses, to make sure that, to show that there is cost efficiency on using innovative technologies, operating efficiency in using these technologies. And we're starting to see that in Philippines, we're starting to see that in Vietnam. Again, as I said, part of it driven by the government, but part of it driven by investors that are coming into this space as well. And it's the same players we're seeing as well, you know, whether it's the Loudest Foundation or it's H&M. Many cases, the brands are the stakeholders that are taking these initiatives because they themselves have a compliance burden, especially at the EU level, less so in the US now. And they are taking initiatives. They're not necessarily deploying themselves in the quantums that they need to because the burden is being passed down to the MSMEs. And at some stage, we need to see brands actually have a commitment, and not just purely at the foundation level, but at the business level to say, okay, this is a viable business proposition for us to ensure that our suppliers are compliant. And we can perhaps help defray some of the risks that are attached. And that can also be done by having offtake agreements, long-term offtake agreements, which, you know, again, there's a very short-term view that is used by the brands. They don't promise long-term commitments towards purchases, which they should do. And I think from the MSME perspective, we're seeing some of that change in the Philippines and Vietnam and so on. And obviously, we had the issue with respect to Bangladesh with the Rana Plaza incidents, where we had an initiative which actually forced a lot of consolidation, but health and safety, fire regulations had a direct impact on making sure that, you know, compliance burden, at least that aspect of it was addressed. So yes, there are learnings that we can take across from within Asia itself that can be implemented in India.
Got it. No, thanks. That's very helpful. In fact, even in our experience at Satwa, both working with DFIs as well as philanthropic offices, both domestic as well as global, we've realized that there is an intent from the philanthropy and DFI side to invest, but there is a lack of investable opportunities on the other side as well. So how do you design right financing instruments and equipment so that both demand of capital and supply of capital can meet each other? We'll come to that in a minute. But before that, Akash, I want to come to you and talk about the equity investment experience. What makes an opportunity investable for you? And what are the areas that you look at? What do you see as the role of, because as Komal was mentioning, there is a requirement of debt, but a lot of them don't see as equity as something that they want to raise, while you've invested in very large projects. And as we were discussing earlier, some of them are earning good returns from the initial days as well. So what makes an opportunity investable for you, and where do you think venture capital will play a role in this continuum?
Yeah, thanks. And thanks for having me here. So we run a fund called Peak Sustainability Ventures. We do equity investing mainly in early stage startups, but then we also do some large scale projects like Abhinav was mentioning. I mean, on the venture fund, we invest only in climate. Around 50% is what we call new energy. So everything from solar technology, hydrogen, energy efficiency, and then the other 50% is food systems, water, alternative materials, plastics. I think at a macro level, we are seeing a huge opportunity. We've looked at around 4,700 companies so far. We've closely evaluated 860 and we've invested in 10. The 10 companies, in our view, and the thesis for the fund is that you can make very large returns in addition to also a large-scale climate impact. We've done that in the past. We were early investors in now some of India's largest companies, like Wari Energies, for instance. We invested at the Series A stage. They IPO'd in 2024, and that was a very, very strong return purely from a financial perspective. In addition, massive impact on India in terms of India's largest solar panel manufacturer. So our view is that you can make money and make a lot of impact in climate especially. For our criteria, we invest at the Series A stage. So we invest in businesses that are commercializing, that have proven technologies, and we look to scale them up with corporate partners. In terms of what's needed, I think for India, one thing is when you think about scale, the scale will mainly come from corporates and corporate partners. And there you really need to diligence and work with corporates to see if this can actually be adopted, if you're meeting the right price points and performance. And so one thing we see a lot is in climate, at least, in the past, people had a view that because it's sustainable, you don't need to meet the exact performance of, say, plastic or cotton, or if you're using silica and we have green silica, then because it's sustainable, it doesn't have to meet performance parameters. I think today what we are seeing is you have to meet the same performance or even exceed it. In addition, you have to meet the pricing that's required. And so those are both sort of reasons to invest. And then the opportunity itself. In fact, one of our investee companies is here, a vertically integrated hemp company. And we are very excited about this for a couple of reasons. They are cultivating hemp up north in Uttarakhand, which has recently been legalized for cultivation. They're working with 250 plus rural women farmers, improving their income from 2 times to 10 times. Hemp also grows naturally in India. It has very high carbon sequestration per acre, and it improves the soil quality, and so it improves water retention and nutrients. And so it's a huge climate play, and then downstream they are processing it into cottonized hemp fiber, working with Arvind, Satluj, and some of these other larger textile players to make India a very large powerhouse for hemp and natural fibers. And so this has a combination of women livelihoods, carbon sequestration, climate impact, as well as reducing cotton usage. And so these types of things are particularly interesting because there are multiple positive benefits, in addition to the fact that we believe purely from a financial perspective, the company can do quite well. And so I think that's the biggest change. Today we're seeing commercially viable, scalable companies in venture capital that you can make good return and make a very large climate impact.
No, thanks, that's helpful. While there will be some companies which will come up Series A and raise venture capital, as Akash was mentioning, as Komal was mentioning, a lot of MSMEs do not have the wherewithal to raise equity. Most of the times they look at debt, they look at development financial institutions, but getting individual financing becomes very difficult for them. So do you think there's a role either for government to play a role, public funds to play a role, or there's a role for orchestration of instruments, say at a cluster level, at a district level, to get multiple of these MSMEs together in an instrument and get financing more at a cluster level, say geographically, place-based financing, either of those, multiple of those instruments can be designed. But what are your views on both public funds as well as design of such instruments at a cluster level? This is a question to you, Girish and Komal, both of you.
Sure. So if I might take an analogy, and that is more from my agri background, which was there in my past life, they faced something similar with fragmented land holdings of farmers, and they came together and created something called a farmer producer organization, an FPO. Now, the challenges that an MSME enterprise faces is primarily one of scale, and therefore the movement to just transition becomes difficult because the gestation period is long, and therefore that initial investment does not come through. Now, like you said, the good thing is that somehow these are geographically, in a particular cluster. So you have Tirupur, you have Ahmedabad and stuff. So something on the lines of, let us say, textile supplier cooperative or something on those lines, wherein they pool their capacity and then the designing of the instruments can then happen because there is a consolidation of the output. And therefore, to take risk, it becomes far more easier at that consolidated level than at an individual level. Now, how to design that scheme, how will that play out? I really have no idea at this stage, but that
we can help you with that.
But that is something that can surely be thought about, drawing a parallel from what has happened on the agri industry, because they face the same challenges in terms of fragmented land holdings. Yeah.
Komal, specifically on government and public funds, is there a role that you see?
Absolutely. We've actually conducted a research report with Loudest Foundation looking at this specific topic, speaking to multiple partners, including funds, including other manufacturers, also in some cases government entities as well. In India, of course, you have these PM Mitra parks that have come up that try to create clusters. Specifically, I think in UP it happens to be one of them, and it's advertised in the Bharat Text magazine as well. So again, you could look at cluster level subsidies. We've seen it with respect to water recycling plants in Tirupur, where there was actually a fear generated that there would be loss of livelihoods, there'll be more consolidation. But overall, as the process went through, it took almost a decade, but actually livelihoods have come back to previous figures, but the water aspect has also been dealt with. In countries such as Malaysia, you have sovereign wealth funds. For example, Khazanah has a foundation called Yayasan Hasana. And Yayasan has used its foundation funding from the sovereign wealth fund to encourage artisans, upskilling of workforce. That type of intervention can only come when a government is committed and they are prepared to put outlay towards this type of work. We are also seeing similar, again, India has very laudable export targets. They're looking at about 100 billion in textile exports by 2030. If it wants to achieve such laudable targets, obviously there could be other things done. For example, looking at, agriculture has a priority sector lending in place. Why is there not such a priority sector lending, for example, for the textile sector? Again, why cannot MSMEs benefit from that? At cluster levels, I think it's easier to approach, credit providers to whether it's looking at decarbonization solutions, whether it's looking at microgrids, whether it's looking at recycling, and also innovative technologies that can be piloted and showcased. So again, I think governments have a role to play. And then knowledge sharing sessions such as this. I mean, it's not been amplified enough to those who are outside. It's a sort of a self-select group that gets to know. I mean, we're hosting our conference later in August as well, and we want to amplify this type of work that the government of India is doing, and similarly bring examples. As I mentioned, Bangladesh took a particular stance when you don't want Rana Plaza to happen, to take a public sector level intervention. And then could be also pooling funds that could be put together, whether it's from a philanthropic side or whether it's from the government participating in helping subsidize debt, credit interventions. There could be some kind of guarantee facilities that could be provided by the public sector as well.
Just a follow-up question on that. A lot of time what happens is that individual investors have respective themes to invest in or respective areas to work on. How do you think we can put together a collective, or what are the common priorities that we can look at for such collectives to come together or collaboratives to come together so that MSMEs specifically can benefit from it?
We've actually done a number of pool funds at AVPN. We've almost reached about $100 million in pool funds since COVID, and we think the sector lends itself to such. We've done more work, and I mean, we come at these things from a climate lens, from a gender lens. We look at it from a livelihoods lens. So there are family offices and philanthropic foundations that are focused on the climate angle, discussing the greenhouse gases, and also water. I think the World Bank has now adopted water as one of the key Water Connect initiatives. Again, it sits squarely within that. So we need to make sure that we then think of how do we leverage some of these things. But it starts with one or two anchors coming and saying, okay, we want to do this. And through that, we corral others. without that initial anchor, and you peak raises funds, and you know how important the anchor piece is. And then also again, we can go back to the DFIs and say, look, there's a philanthropic pool fund. Why don't you come further along the capital stack and participate in this? Here's the philanthropic pool fund to help de-risk some of the investment in this space.
Akash, what can we do, or what can the sector do to help boost your pipeline? How can more waris come up to you? What are the critical bottlenecks that you think, if addressed initially, would bring, say, 100 such waris to you at a Series A?
Yeah, I mean, like I mentioned, we're seeing a huge pipeline. I mean, 4,700 companies, not just in India, but globally, but focused on India is quite a substantial amount. Wari, I mean, see, not every company will IPO, so I don't think that is the benchmark, but strong returns, good exits, cash on cash returns is what we look at. I think building pipeline, see, we invest at Series A stage, so obviously earlier on in the capital stack, the seed investors, in this industry in particular, for instance, like Fashion for Good, we've co-invested on 2 deals with, helps build that pipeline, helps connect these innovators initially, helps do that, some of that diligence. I would say more broadly from the sector perspective, you're seeing a huge amount of momentum. I think what's interesting about textiles is that it hits multiple sectors. So we have a climate lens, like I mentioned, energy, food systems, water. For textiles, I mean, what's unique is it's one of those sectors you use a lot of thermal power. Right now, I mean, predominantly coal-based, but you're going towards biomass-based, eventually electrification. And so that then deals with all of what we're seeing on energy, on solar, energy storage, heat pumps, things like that. Then secondly, I mean, the sector uses a huge amount of water, and there is a big need to reuse some of that water. Like Girish mentioned, one of our first investments in the fund was a company called Indira Water. Initially, they focused on the textile segment, where they can treat very dirty industrial wastewater for reuse and safe disposal, right? And so you need solutions like that. Now they've expanded more broadly into sectors like steel, mining, metals, chemicals, things like that. But that's an area where also textiles touches. And then, I mean, lastly, it's materials, high performance materials. In terms of what can make pipeline better, I would say going back to what we talked about in terms of what it takes to scale up, a large part is that working with corporates as you're designing your solution, making sure that you're in a position where it can scale both from a performance perspective as well as pricing perspective, and brands will adopt it. We've seen many times, especially in this sector, pilots happening with global brands, and then nothing happens from there. I think now the shift is required such that you're looking at things like, I've built enough capacity, I have a sort of guaranteed feedstock, consistent quality, high performance, blendability, and then also the ability to scale with the brand. So, I mean, to see another Wari or even anything like it, that's what we are looking at. In addition, I think late stage capital is definitely quite interested in India. We have co-invested with the likes of Aramco Ventures, Barclays, Santander. You're seeing a lot of interest in India. People who will take our positions out will be later stage capital investors, or if the company becomes profitable, then they'll either buy back the shares or they'll potentially even IPO. And so the depth of market is there. You're seeing good exits and good returns. So I think it's just a matter of time.
Komal, you spoke a lot about brand commitments or commitments in the open market, but a lot of them have not transitioned into action on ground. What do you think are the key bottlenecks over there? And is there anything that the sector or we as proponents of the sector can do better to make sure that some of them actually translate to impact on ground in a much better way than what they are doing today?
I think they've obviously themselves faced a lot of regulatory pressure, especially with respect to the EU, and a lot of brands are EU. I mean, if you think about fashion as a whole, a lot of it is coming out of Europe. So I think they have not been able, I mean, they have so far stayed isolated and tried to push the pressure down to the supply chain. And that has to change because it's all about scope 3 emissions, right? So they can talk about their own scope 1 and scope 2, but scope 3 actually comes right down to the supply chain, right? So the supply chain is obviously has faced a disproportionate burden on helping the brand meet its obligation. And again, it's the MSMEs, the supply chain is very fragmented. I think there is obviously consolidation happening, but I also think at the India level, we will see a greater amount of regulation, which will mean there will be, again, impact metrics that would need to be met. MSMEs don't have that kind of metric reporting obligations right now. And there is definitely an obligation by the brands to be able to help these supply chains become more sustainable, whether it comes to the workforce, whether it comes to the water, whether it comes to, with respect to greenhouse gas emissions. So I think there is definitely an obligation on the brands, but the fact of the matter is they're buying from different sources. So they're fragmented at this stage, so therefore they're not committing to any one source of MSMEs. Perhaps there needs to be a greater level of consolidation from different brands coming together, perhaps a brand-related sort of pool fund, which then helps to de-risk what's happening with respect to being able to put capital to play. Because again, bearing in mind some of these technologies for the MSME sector, it's a long payback period. They're not necessarily, and banks and so on are lending with small working capital related, these are working capital loans, they're not necessarily for CapEx. So I think, again, that CapEx level kind of intervention is perhaps some of that, whether, as I said, interest subvention or guarantees or some kind of collateral provision needs to come at the brand level, so that therefore these MSMEs can go ahead and meet the obligations that they have. But this is along the pipeline. I definitely see it coming, and I think some brands can actually present themselves better by taking this initiative forward. We know Loudis is there, we know H&M is there, we know IKEA is there. We'll see more of that happening. Inditex took that action when it came to Bangladesh, but they need to, these are the suppliers of Zara and so on. Yeah, so again, we'll see some of that happening too.
No, I agree with you, and we at Sattva Consulting have been talking to some of these brands, and the interest is definitely there to design something that can flow down to the MSME space. Girish, Komal came at it from a top-down approach. If I ask you from a bottom-up approach, what can these textile manufacturers do differently to secure some part of this transition capital? So even if a collective is put together, not everyone will be able to secure capital out of it. So how can these manufacturers improve their chances of participating in such a collective or securing capital out of it?
That's a tough one, but if I may kind of share a roadmap perhaps. One is to start small, and second is to look at it more from a business case perspective than doing just transition for the sake of just transition. So as long as this gets integrated somewhere into the regular business, you start small and you work on it the conventional way, which is the regular initial equity up front and then taking some debt from the bank and then pre-testing that with some of the brands. I think that should be a good way to go.
Thanks. I'll close this panel over here. I'll open it up for Q&A from the audience. Yes, please. Can you just state your name and if the question is addressed to a particular panelist or to all?
Hi, I'm Siddhant. I'm an independent designer, and I'm actually working on converting my organic farms to be used for textiles as well. And I'm just trying to actually involve a couple of villages around our farms so that we can show a more seed to final fabric plus final product kind of a stage. I was just wondering if any kind of financing is available for like the handicraft sector or something which is completely at a seed stage right now.
I would not know about it, but perhaps what is there in the system is the PSL part, priority sector lending, which is available with the banks. And as long as it is a structured organization with a 3-year balance sheet, I think some money should be available under the PSL scheme, which is at perhaps, I don't know, perhaps 7.5 or 8% currently.
So we would probably need like a 3-year.
Yeah, so that is on the debt side. Now, on the initial investment side, the correct way to go about it perhaps is to make a business case out of it first, and then approach. Then perhaps what may perhaps work is a blended finance kind of a thing with a grant component and then an initial investor into the business. That is the way I would perhaps look at it. But I think we must also hear what Akash has to say, because he's the one who looks at it more from a risk assessment and equity perspective.
Yeah, I mean, I would say at this point, there is financing available for almost every idea. It just needs to be compelling enough. Now, based on what you said, although I don't know much about it, if you created a compelling narrative, I mean, there are investors that will fund just the idea if you make them interested enough. And these would be family offices, angel investors, especially just 1 or 2 high net worth individuals. Based on what you said, I mean, it should be kind of this seed to product, traceability, livelihoods, and you create this compelling narrative that is both climate as well as health and livelihoods, then I think you could make a good case. And especially then if you had a business case rather than purely impact, there's way more money available if one can also make money in addition to impact.
Well, would that be against equity or philanthropy?
Equity. No. I would say honestly, grant you can go for. The most amount of money is in equity. And within equity, it's in anything that has a viable business case. And so, I mean, it's not that, I mean, I'm sure if it is going to be a sustainable business, you would have to think of a sustainable business model. And so if you think about it like that and you create a compelling narrative, you put a deck together and you just try to meet a couple of individuals and you do some online research, I think that alone you'll start to get a sense of the market and where it's at. Usually most of the companies we've funded, the very first checks that they've got, they've convinced a couple of family or friends or local references for that initial capital in addition to funding it themselves. Once that happens, then you start to build up.
Thank you.
I've also got another suggestion, which hasn't been, perhaps we haven't seen much of, but should be there, which is corporate venture capital. You have large businesses such as Shahi, Arvind, and so on. Why do they not have corporate venture capital arms that can do some kind of blended finance work, give early stage grants to innovative enterprises, innovative solutions for them to scale? Again, this is something that should be presented to these entities to put capital aside. They are multi-billion-dollar businesses, to put some capital aside to foster innovative ideas, accelerate these ideas in businesses.
No, the limited information that I can share is that some of that is already under discussion.
Hi, my name is Mrinalini Thakur and I'm a sustainability officer for the India region, one of the French brand, which is Group Bemanoir. My question is regarding these small MSMEs. As Komal said that 90% of the MSMEs control the supply chain in the Indian region, and these MSMEs in today's era, they are much involved in the social aspect of the sustainability, but when it comes to the environmental aspect of the sustainability, it becomes a bit difficult for them to invest themselves on this aspect, whether it is related to the renewable energy or the water recycling part. So And brands, because in today's scenario, the global dynamics are rapidly changing. So for the brands also to depend on one country and then prioritize their supplier, it's a bit difficult. You know that today's era, how much unstable the world is. So what role can be played by the banking sector or the investors when it comes to like installing a solar plant in a small MSME or small entity? So what role a banking sector can have?
I can take that.
Yeah, please.
Yeah. So looking at it from a banking sector, as Girish was mentioning, while they have priority sector lending, some of these businesses are initially they don't have they have a longer gestation period than what banks would like to invest in, and hence it becomes difficult for banks to invest in such projects. The initial capital, as you were saying rightly, should come from, and we were discussing it earlier in the panel, a collective or some sort of a philanthropic guarantee can make it more investable for the banks, so that the risk goes down and the gestation period during the initial period where the risk is higher, banks can then take on that risk. So that's the way I would approach.
Okay, thank you. And one more point in this, like if every MSME has also, if they are also calculating their scope 3 emissions, so is it possible, or is it currently in the scenario that like if bank has lended a loan to a MSME, then how much sustainable they are, so their rate of interest depend upon like their sustainability. Like in Europe, it's currently happening, like banks do consider their scope 3 emission to decide the rate of interest.
I mean, in India at the moment, that is not happening. I think the first place these banks have started is similar to the agricultural sector, where there was a mandate that a certain portion of the banking has to be going into that sector. Similarly here, you're seeing cluster-based financing where banks will fund a large capex that can then be used for multiple different MSMEs, right? So that the amount of capital each one puts up is lower, as well as then the risk is lower for the bank itself. I mean, you're not seeing variable interest rate based on scope 3 emissions, but you might in the future. At the moment, though, what is very good about the sector is you're starting to see commercial banks look at this from sort of a climate angle and start to allocate a portion of their book into things that are decarbonization, water, and those sectors.
Thank you.
Yeah, I do agree that sustainability-linked loans haven't taken off in the same way. And there are funds globally that are investing in sustainability-linked loans and promoting them, whether it's the Green Growth Fund or whether it's Climate Fund, Green Climate Fund. So I think we will see there are organizations, investors, global investors who are interested if corporates are going out and raising these sustainability-linked loans. And those sustainability-linked loans do not just only need to be climate-focused. You can have gender-related bonds. You can have livelihoods-related bonds. So there's a whole spectrum of them that could, again, India is very keen to have its debt market grow. Perhaps this could be something that could be added to that.
That's a clear case for a blended finance instrument to get philanthropic capital to link it to sustainability link. Yes, sir.
Okay, I'm Pinaki Das from Association of Synthetic Fiber Industry. Many of our members do have sustainability drive. Even as a professional also, I put up the first chemical recycling plant of polyester 30 years ago. Now, Government of India, Ministry of Textiles in particular, they have initiatives, number of initiatives, and TextEco is one of them. So where the sustainability, incentives are been built in for the newcomers, for the new sustainable ventures. Now, when it comes to the financing part, and particularly the debt, equity, crowd fund, or and the venture capital fund, etc., when that will come into play for these new ventures, the benefits of that, whether that will still remain along with the incentives or support in the tax ecosystem. I mean to say that the tax eco has given some benefits in some form from the Government of India. And then when it is coming from these funds, that will over and above, it will remain the same, so it will be coupled with both the incentives, or it will be debarred from, or some way cut down from the, once the incentives are there from Government of India, means in the under tax eco scheme.
I don't think they can run parallelly. I don't think that will.
No, it's an incentive. It's an incentive. See, it's a financing part, which is a part of finance. You do it through debt or equity or crowd fund, and it is an incentive initiative. Means when you do, go for these ventures, so you get a support to initiate this objective. To do less carbon emission or sustainable drives in every sphere in textiles. Now, so that is an initiative. For that, you are getting the support, right? So that no way linked or connected to the financing parts in the normal business venture.
No way linked.
So that's why both should remain. My point is that whether it is to be supported or means you have any say on that. So. Like to know on that front.
Yeah, okay. So many...
Because many people are coming. I'll say, when we started around 30 years ago, there were 1 or 2 recyclers. Now today, there's 40, and then day before yesterday, I came to know there's 46 players. And polyester, we are number 1 in the world. In terms of recycling and sustainability. And there are many other fibers also. It's a the buzzword actually. Yeah. It's actually been executed.
Yeah, so there are multiple organizations that receive this multiple viability gap funding from the Government of India. Now that funding can be an incentive, it can be a subsidy, or it can be a viability gap funding. That has never been a deterrent for capital to move in. So as long as the business is viable and these instruments and support from the Government of India do enhance the competitiveness and do make it a more stronger business case, so that should never be a deterrent for any capital to move in. In fact, incentives like these, they are enablers of capital to move in because they strengthen the business case.
Both should remain in parallel to increase the competitiveness.
Of course.
In short. Thank you.
You have a question? Okay. Do you?
I did have one, but so if we don't have time.
We can take one quickly.
Okay. No, first of all, thanks for the discussion. My question is really related to, the fact that there's so many instruments that were spoken about. There's one level of who can make the instruments, and then there's the second level of who is actually going to put money into these instruments, right?
Yeah.
I don't see enough of the who is putting money in the instruments. At the end of the day, I represent a philanthropic foundation. Everybody comes to philanthropy, right? And on one level, philanthropy is asking, why is everyone making money on philanthropy, right? And then on the other level, the question is, why isn't anyone stepping in where philanthropy should have set the base? So, where is the money coming?
So, we discussed that philanthropy capital is also required to pool the funds, right? But the philanthropies that we see in the space are really the 3 that Komal you mentioned, right? We are not seeing more philanthropies coming in, and even from the venture side, I know Peak Ventures is there, but not many more like that, or Peak or Omnivore likes are coming up, right? So what does it really take to get more investors and more philanthropies interested in this space so that more capital starts to flow?
May I just add to that? So actually just adding to that, so what policy interventions do we need to see in India to attract more, say, sovereign wealth funds, family offices? Do we need to raise the FII limit, direct tax code? What is pending in the government policy sector that could attract more investments? Thank you.
Sure.
So I cannot comment more on the policy side. That is, so we can leave that aside. But on the other things that you have mentioned, as long as it is a compelling business case or has the potential to become a compelling business case, backed by a very strong narrative like Akash mentioned, I think capital always flows in. Now, why has it not flowed in? Is because certain businesses, so for example, let's again, I'm sorry for doing that, let's again go back to agriculture or agribusiness, where a sector that I come from. Now, everybody would assume that you would have a very strong business case for agribusinesses. You would have very strong case for agriculture and investments getting into agribusinesses. But in India, over the last 15 years, there has never been an agribusiness unicorn. And the reason for that is perhaps the business models were not correct that got invested. Perhaps the time to scale is longer, the gestation period is longer, or perhaps there are nuances that are difficult for investors to understand immediately at the first instance. Not very easy for the promoters also to understand and grapple with in the first instance. So as long as the business case becomes compelling enough, and there is, apart from the sustainability angle, there is also a sustainable pathway to profits. When that happens, money will come in.
Yeah, and just adding to that, I think three main reasons. One, there is a lot of fragmentation, which was discussed earlier on the panel as well. That fragmentation makes it very difficult to invest. So some level of consolidation would probably attract more capital. Second, division of risk at the right level. So as someone was mentioning, sorry, I forgot your name, that small businesses do not have margins to invest themselves. Hence, there needs to be some other form of capital which takes that risk. It has been philanthropic capital so far, but why can't philanthropic capital work alongside debt capital to subsidize some of that and make sure in the longer term debt capital takes over rather than philanthropic capital working on a long term? And three, I would say regulations also have a role to play over here. I won't comment specifically on policy, but like in Europe, it has been top down from a regulation perspective. India does not have such strong regulations about MSMEs or even textile manufacturers. It does have at the sovereign level, but not at the individual level. So those are the 3 points.
I would just make one point also that, like, I mean, we've been in this space for like over a decade and a half. Our first deal in water was 2009. The rate of growth has been immense. Climate was one of the top funded sectors last year in VC. And so, I mean, you're seeing that literally in front of your eyes in terms of what's happening in this space. A huge amount of capital is coming in. And what's interesting is commercial investors too who are generalists. For instance, we've co-invested with Bloom Ventures, with sort of other funds that purely don't even have a climate mandate. Yet climate has become one of their core sectors within a generalist fund. And so, I mean, it's still low. It could always be more. But the rate of growth has been immense. And so next few years, this is the right space to be building in.
I agree with Akash. The trajectory is in the right direction. Definitely, I think some of the policy interventions will help. For example, having government perhaps underwrite some of the costs of perhaps sustainability-linked loans if they're being issued. There could be, again, structures that clusters, as we discussed, rather than individually MSMEs going out and raising capital. Clusters is another mechanism that we've seen. But I agree that we are going to see more of that, and partly being driven by the brands themselves who have a greater compliance burden coming their way.
So while we discussed a lot of problems that the sector is facing in terms of financing, we are ending this on an optimistic note that there is more capital flowing in both from the brands as well as from the equity investors. So thank you for being such a wonderful audience, and thank you for the participation.
Sorry. The official photographer didn't do that.
You can share that folder.
Jack of all trades.
Thank you, sir.
Thank you.